Multiple billionaire investors are loading up on gold, including hedge fund founder Ray Dalio and real estate mogul Sam Zell, meaning now is the time to own gold. One precious metals expert is stepping forward with a big prediction. He believes we could see gold reach as high as $3,000 by the end of the year, possibly higher. So find out why and get instant access to his #1 gold investment for 2022. It's not bullion, an ETF, or a mining stock. In the past, folks using the same gold strategy could have been able to make nearly 50 times their initial investment. Considering how quickly the price of gold has been moving, you don't want to waste any time missing out on the gains he believes are in store for this investment. So to get a copy of his new free report with all the details, simply go to 2022goldmania.com. Again, that's 2022goldmania.com for a free copy of his new report. Hi, this is Daniela Cambone, and welcome back to Stansberry Research. Fan favorite Lawrence Lepard is back with me today. Lawrence is the managing partner over at Equity Management Associates. Lawrence, always good to be with you. Welcome back.
Likewise. Thank you, Danielle. It's been too long. I always enjoy being on your show.
Yes, and we're going to talk the Fed, we're going to talk inflation, we're going to talk gold, we're going to talk Bitcoin, all that good stuff.
Absolutely.
But first, I want to start with a poll that you actually spoke about, and I've been seeing all over the headlines about how Americans are not happy and satisfied with the direction of the nation. A recent NBC News poll found that just 16% of American adults actually think the nation is headed in the right direction. Only 16% feel that we're headed in the right direction. What do you make of the sentiment right now in the U.S.?
Well, they're not stupid, and it is pretty bleak. I mean, the similar poll I tweeted that a similar poll showed that in 2008 the low number for that survey was 12%, and of course some wags on Twitter said, "I'm surprised it's double digits." Look, it's this is no mystery. All your viewers and listeners know this. I mean, inflation is just roasting people. I mean, it's just horrible. Gas prices, food prices, you name it, and it can't be ignored. And of course, our leadership's trying to blame it on Putin, but that's not really what it's all about. That's a piece of it, but a very small piece. And it's terrible, right? It's very bad.
So that's an excellent segue to my question and the main topic at hand. I really want to dive in with you today is the American Rescue Plan, right? We saw how the massive spending law, which included, $1,400 checks for each person in a family, generous expansions to unemployment insurance and child tax credit benefits, and hundreds of billions in aid to state and local governments was intended to help the people in need and stimulate economic demand. But here we are at 40-year highs of inflation. And my question to you is, Lawrence, how much of that rescue plan do you think impacted and worsened the inflationary environment we find ourselves in today?
A good piece of it, Danielle, but it's not all of it because there were plans before that. I mean, I think the big number is the Fed balance sheet has grown by almost $5 trillion, which is more or less monetary, money creation, and M2 has grown by 40% in the last 2 years. And I don't know what was the rescue plan of this one. Most recent one was $1.6 billion, I think. So it's a piece of the whole puzzle, but that's not the entire enchilada. I mean, there's just been a lot of money raised and printed, and the problem the Fed has is they can create liquidity, they can print money, the government can send out checks, but they can't control where it goes, and they
Mm.
can't print goods and services. And so, no surprise here, you create that much additional money, so to speak, whether it be through M2 or direct checks to individuals that are a part of M2, et cetera. And, you're going to have inflation. And that's why, sadly, it's bad inflation, and sadly it's going to get
Right.
worse. I mean, they think that they're going to be able to get it under control, which, I think is a joke, and we'll talk about that. But,
Yeah, we'll
it's
talk
a
about that.
mess.
And to be fair, Lawrence, I guess, how do you find a balance of trying to help Americans, right, during a time like the pandemic where people were out of work, everything's closing? How do you help the nation but not create runaway inflation?
Yeah, look, I don't, I try to stay away from political matters, but as a general, in general, I'm all for helping the nation. I'm all for trying to be fair. I think that what was done in the pandemic was somewhat misguided. I mean, the PPP money, a lot of that went to companies that didn't need the money, to the degree that the government was going to intervene, and if we'd had a sounder monetary system, they wouldn't have needed to intervene. But set that aside, if they were going to intervene, it struck me that the money should have been very targeted at the industries that were most directly affected, airlines, hotels, and hospitality. And if your business wasn't in those areas,
Mm. Yep.
I know lots of very healthy businesses that just got large checks from the government. And there's no way that that can't be viewed as being extremely inflationary.
Yep. I agree with you there. So now the Biden administration, focused on taxing the rich. You saw Bezos having a major issue there. Bringing down the deficit is, Biden has said, is one way to ease the inflationary pressures. Do you agree with the administration here?
Oh, yeah. Like again, I try to avoid politics, but
I keep
I mean,
bringing you back to
yeah,
politics.
it's okay. I mean, no, I really don't. I mean, look, taxing the rich isn't the solution. Cutting spending is what they should be doing, but of course they can't do that and they won't do that. Um, it's the system is very far gone, and what they're trying to do now is put band-aids on gaping wounds, and it's just not going to work. So and this isn't a red thing or a blue thing. This is a larger system problem that can only be solved, in my estimation, by returning to a sound money standard. I mean, we should reset the currency with a sound neutral reserve currency underneath the money supply that we now have. Otherwise, we're going to continue to have these problems, and it's just going to be whack-a-mole. It'll pop up when we're in one place and they'll hit that, and then it'll pop up another place and they'll hit that.
What does that look like for you? The sound monetary system? Are you talking
Well, I
about
mean,
like a
we had
reset
one,
or
yeah, we had one pre-1971, right? We were on, a gold standard. It wasn't a
right?
perfect gold standard because citizens couldn't hold gold until 74 or 5, but at least at an international level, there was exchangeability for gold. Of course, that blew up because the US ran deficits and international people didn't trust us to do so, and so we went off the gold standard, and that's when a lot of the financialization of the problems that we've occurred started. So we should return to a neutral reserve currency. A lot of choices, anything energy related, gold would work, Bitcoin would work, oil would work, something that's a basket of those would work. I mean, Keynes talked about using a Bancor way back at the Bretton Woods agreement, in the 40s. So we need a sound money. When you're trying to run an economy with a measuring stick that's always changing, which is to say, with a dollar that can be printed by pushing Control P, you're going to get suboptimal outcomes. Nobody knows what the right price is of anything, and the Fed, you've got one small group of people trying to set the price of money. I mean, recall, just as an analog, recall back in the days of the Soviet Union when they used to set the grain. The Politburo used to set the grain price, right? And if they set it too high, they got too much grain. If they set it too low, they didn't get enough grain. And the free markets don't operate with fixed prices. And that's the fundamental problem here, that the money, the monetary system we have is being driven by a fixed price of money, which is being set by the Fed. And it's wrong. It's wrong at a lot of levels. It's wrong at just an engineering level. It doesn't work. But I would submit it's even worse than that. It's wrong at a moral level because it benefits certain people at the expense of others. So I'm a strong proponent for returning to some form of sound money. And there are a lot of different forms, but one can be certain that the fiat dollar is not one of them.
So I had a great conversation recently with E.B. Tucker,
Yep.
and he was saying actually this is just a mirage. We're made to think that inflation is the Fed's top mandate, but it's really keeping the U.S. dollar propped up now, and that's why we see the U.S. dollar higher when in fact during tightening cycles we would see the reverse. But at all costs, they're trying to keep the dollar higher because they're afraid of losing the reserve currency status. Do you agree with?
Absolutely. Completely agree. EB is very correct on this, and I agree with his analysis completely. I mean, the U.S. lives the life we live the lifestyle we live because the dollar is the reserve currency, and we can print dollars to get goods and services and oil from other countries. And what the world is saying, what the world's starting to say is, hey, we don't like that. I mean, in particular, Russia just said that. Now, Russia's a bad actor and they started an illegal war. But with respect to the monetary system, what they did was they said, we're not going to accept these dollars and euros anymore. If you want what we have, which constitutes oil, wheat, and gold and natural gas, you're either going to buy our rubles, which we can then use to buy your machinery, or you're going to pay in gold. Or there was even one official who said you could, conceivably pay for it in Bitcoin. So the world is getting fed up with the abuse of the dollar that we have, instituted for these many years, and you see it in a lot of other places too. I mean, we're having a hard time selling our treasury bonds, right? Until 2014, we could run deficits and the foreigners would buy our treasury bonds. Since 2014, foreign purchases and foreign holdings of treasury bonds has declined rather steadily. And so, and then when we do things like we go out and we seize the Russian foreign currency reserves, that's not exactly reassuring to Brazil or India or Saudi Arabia or anybody else who might be a potential buyer of our treasury bonds. And they're like, hang on a second. You mean if we do something that the U.S. doesn't like, they can seize them? Well, maybe we shouldn't buy those. So, but yes, EB's point that this is somewhat about maintaining the reserve currency of the status of the U.S. dollar is dead on correct. And that's why Powell is channeling Paul Volcker and trying to push rates up and be as, talk about QT. But, we haven't talked about this yet, but I'll just add, I strongly believe that's not going to work, that something's going to break. And just like, Powell said, a year ago or a year and a half ago now, I guess, that inflation is transitory. It turns out he was wrong and it's not. He's now saying, we have an inflation problem. He admits that. To maintain credibility, he has to admit that, right? I was wrong about transitory, but we have an inflation issue and we know how to deal with it. We're going to trim, we're going to start to sell off the balance sheet. We're going to reduce the balance sheet, sell bonds into the marketplace, and we're going to raise interest rates. And that's just, okay, fine. That's the bluff. That's what he's saying he's going to do. And he's going to start doing it. But to my way of seeing it, it indicates a incredible naivete or just a calculated plan that he's going to do that until something breaks. And then when something breaks, he's going to be forced to pursue what we all call his third mandate. I mean, he has two mandates, right? He's supposed to maintain full employment or work towards full employment. He's supposed to keep inflation low. Of course, those conflict with one another to some degree. But the third mandate, the shadow mandate that they've talked about a lot, is functioning financial markets. And, in the COVID crisis in March of 20, the U.S. government bond market went no bid. And, that could happen again. And if it were to happen, you can bet that, they would be taking rates back down to zero. Of course, only at 1% now, and that they would reverse this quantitative tightening and perhaps even go back to quantitative easing. And I think that when those things occur, the sound money assets that my firm invested in, that so many of your listeners invest in, they're just going to scream upwards. They're going to go bananas to the upside. And so, that's a good thing for all of us. The bad thing is that, because they're driving this clown car between inflation and deflation, we get it's very volatile what we're doing, and that's no fun. But I'm pretty sure we're on the right side of it.
Let me ask you this, Lawrence. I hear everything you're saying, but to your point about reversing course, I mean, it would have to be something pretty substantial that would have to break. When you say something has to break, what would it be? Because, speaking about optics, here he is, raising interest rates to all of a sudden, do a 180 and say, oh, hold up. Now, we're going to go back to quantitative easing. I mean, that's not going to look really good, right? It's going to look like they're all over the place. So how do you justify it? What has to break?
Yeah. So I don't know. I don't know what they have up their sleeve, but you're right. That's not going to look very good. And he's going to continue to squeeze rates up, and he's going to sacrifice the stock market. There's no doubt about that. And what he's trying to do is perhaps save the bond market or save the dollar. But what's going to probably break, in my estimation, Daniela, is the bond market. I mean, even 1%. I mean, look, the negative real yield on a 10-year bond right now is absurdly large. I mean, it's rarely, if ever, been this large. I mean, reported inflation is 8.3. Shadow stats inflation and import inflation is running more like 15 to 18%. And we've got a 1% Fed funds rate. I mean, that's just a joke, right? I mean, and every single time in the past, when the government had this kind of a problem, they had to raise the Fed funds rate over and above the inflation rate. That's what Volcker did. Now, if you can imagine, I mean, and of course, and that was back then the inflation rates were more accurate. But go with the inaccurate 8.3%. That would imply he'd have to take interest rates to 9 or 10% in a highly leveraged, highly financialized economy. I mean, the economy would just blow up. I mean, we would have a depression that would make 1929 look like kid stuff. I mean, you got to remember that when Volcker did what he did, we
Yeah.
only had 30% U.S. debt to GDP. Right now, we've got
Mm.
125% U.S. debt to GDP, right? It's a big difference. And so at 125% debt to GDP, you take it to 10% interest rate on $30 billion worth of debt, that's $3 billion of annual interest expense. That's almost as much as we collect in taxes every year. And that would make the U.S. budget deficit, just blow out to enormous proportions. I mean, it's running between 1 and 2.5 right now. Add 3 to it, and it gets silly. So, they're really trapped, and you've heard this term before. I mean, the Fed is really trapped, and they're trying to pretend like they're not trapped,
Yeah.
but that's
Yeah.
really all it is. It's a make-believe pretend, because the market is going to call him, and he's going to have to lay down his hand, and he's going to be bust. He's got nothing. And so, you say, well, what could break? I think what's going to break is, I think that, well, a couple of things going to break. I think the stock market's going to break. I think the negative wealth effect is going to break. I think that will then take down tax revenues and increase transfer payments. So, you're going to start to have a blowout in the budget. I think even with those things happening, he's trying to create demand destruction to take inflation down. I don't think he's going to succeed. I think inflation's going to get higher because this isn't demand driven inflation. This is cost push inflation. It's different. And so I think inflation is going to get higher. And so ultimately, my way of seeing it, I think the bond market's going to break. I think people are going to look at it and say, you know what? These guys can never stop printing. We're getting a 1% yield or I'm sorry, a 3% yield on the 10-year, and inflation's running at 8% and going higher. I'm out of here. Bonds sold to you, Fed. Then the Fed's going to have to do yield curve control, which the Japanese just did as their bond, went up 50 basis points. And look what happened when that happened. The Japanese currency went down 20% in 3 months. So, they're trapped. And eventually, people are going to come to realize that, this guy is the wizard in the Wizard of Oz. I mean, he's just pulling all these levers and saying, don't, ignore the man behind the curtain. But it's broken. The currency is fundamentally broken. The government structure is fundamentally broken. The only way out of this would be to take an enormous, enormous depression slash recession and try to balance the budget. And I can't see them doing that. I think that the choice of doing that versus, reversing course and, I mean,
Mhm.
look, we've even seen things like, inflation is raging, right? But you see California saying, well, we're going to send out $500 to help people, deal with their gasoline costs. Well, okay, where's the 500 coming from? And doesn't that just make the problem worse? I mean, you can't, and if this gets bad enough, my sense is because we ran it in the COVID crisis, people are going to say, you got to send me a check. I want some universal basic income. I can't afford to drive. I can't afford to eat. Send me some money. And more than half of the country that votes is going to want that and push for that. And government will probably do it, and that'll make the deficit worse. And what eventually happens here, Daniela, is people
Yeah.
see that it's a doom loop. That the only way to keep it going is to print more money, and yet printing more money is what causes the problem. And so if you ever stop, you can stop printing the money, but it's going to look like 1929 or 1930 as everything collapses, right?
What you've described is just an absolute disaster, Lawrence.
I
Um,
know, and look, I'm not
I,
happy about it, and I kind of wish it wasn't going to happen, but I'm just an analyst. I mean, I just sit here and try and figure shit out, right? And that's
well,
and
and
that's
we
kind of what I
appreciate
see. It's
that.
kind of what I
Yeah.
see. You know what I mean?
And I want to talk solutions and opportunities in a bit.
Yeah,
So hold that thought because there is a positive
I
point
hope
here. So
so.
I hope so. But just two bottoms I want to bring up. You
Yeah,
mentioned inflation. You mentioned the stock market. From what you're alluding there, there's more pain in stocks to come.
I strongly believe that. Yes, we're in a bear market, and we're still, we were probably almost two standard deviations above fair value. Now we're probably one and change. I mean, it's nuts. It's absolutely nuts. And yes, I think there's a lot more pain to come in stocks, with the possible exception of stocks that are focused on commodities. I mean, I think
Yeah.
the big macro trend that occurred here is we reached peak financialization, peak technology, and growth, and with the fangs and so on and so forth. And we ignored. I mean, this is Jeff Curry at Goldman Sachs' point. He does a very good job. I recommend people listen to some of his videos. We've really ignored investments in commodities and stuff for a long, long time. And gold, silver, wheat. I mean, you name it. It's all been ignored because prices were stable and nobody thought, we should be increasing our capacity here. And now, as it turns out, when things get a little bit rough, we realize we don't have enough of that stuff. Particularly when you've got kind of, geopolitical noise going on, and so the shipping gets all messed up, and you can't send things from A to B very easily, etc. So, we've got to go invest in that stuff, and the supply response. This is what I say. This is not demand pull inflation. This is cost push inflation because we can't quickly add supply in those areas. This inflation is going to persist. So in a way, Powell is kind of giving us the worst of both worlds. I mean, it's stagflation, right? I mean, he's
Hmm.
going to basically tamp down the economy and try and create less demand. Okay, fine. That's one thing you can do, but it's not going to solve the inflation problem. And the inflation problem is still going to be there. And
Well,
so,
yeah, well, you beat me to the other bottom question I want to ask you because we saw inflation come down slightly in
right.
April. And some experts quickly saying, "Oh, this is we've hit peak inflation. It's all good." But you're saying, "No way, Jose," basically.
Well, yes and no. I mean, look, if you go back and you look at the 1970s, there were a bunch of waves of inflation. I mean,
Hmm.
just so you know, the 5 year out swap on inflation is saying inflation is going to go back down to 3% in 5 years. Okay. That I say absolutely no way, Jose. It was eight, what was it, 8.5, and then it came to 8.3 last month. I mean, could it go down to 7 or 6? Sure. Is it going back to 2 or 3? No way. Absolutely no way. We've got an upward trend, and that goes back to the supply issue and the underinvestment in commodities. So I think
Yeah,
we've now entered an inflationary period that's going to look like the 70s. I remember the 70s. I was a teenager, and inflation just persisted and got worse. However, there were, it would run hard, it would back off, it would run hard, it would back off. In the 74 period, the Fed tried to tighten a bit and inflation came down. The stock market also took a huge hit. Very similar, actually, right what we're in right now kind of looks like 1974 if you go back and study it. And, I mean, it'll wax and wane, but, it took Volcker taking inflation rate or interest rates to 20% when inflation was in the teens to finally put a nail through the heart of inflation.
yeah.
And 1%. I mean, we haven't even started yet. We got no QT and we got a 1% Fed funds rate. That's not going to do it, right?
So let's talk about sectors
Okay.
that
Yeah.
you like, and where you can kind of seek some sort of safety in this environment where nothing seems safe. I mean,
Yeah.
when Target and Walmart are struggling, it's
Right. Well,
it's
and
really
that's
bad
because they
times here.
were
But
a tad overvalued. I mean, so look, just in general, I think the stock market has. I mean, it's funny. We printed all this money and we grew M2 over the last 15 years or so on and so forth. And so, but we didn't have much printed and reported inflation. As we all know, inflation was kind of running 2-3%. It was pretty tame. But we had a lot of inflation in stock prices, right? I mean, all the stocks. We had one hell of a bull market in the last. I mean, and go look at a chart of the S&P. I mean, it's been, just the constant refrain has been buy the dip, and it's worked. So, I don't really think you can hide in stocks, although at least stocks represent earnings claim on a business that'll be around after we do a currency reset. So that makes them better than bonds. I mean, the first thing, and you look at the 70s as your analog, the bonds were just a terrible investment. I mean, you lost like 80% of your purchasing power. It's horrible. So you got to be totally out of bonds. Then when you go to stocks, I mean, I tend to, in the stock area, I'd say, well, if I were going to hide in stocks, I'd try to hide in commodity related recurring business, recurring revenue businesses that have decent valuations. And there are some out there. I mean, it's not just you got to buy gold, you got to buy silver, you got to buy oil. But if you look at the 70s, what performed the best was gold, silver, and oil. I mean, three things that had limited supply that were commodities that were needed, right? So I think those are the best place to be if you're going to be in the stock market, in companies that are related to those three things.
So I know you've been a long time, gold bull, if that's a okay
Oh yeah, big
terminology.
time, forever.
Um, and you've been waiting. You've said, hey, fireworks should come for gold. I know a lot of gold investors
Oh
waiting
God.
for those fireworks. So, how would you describe? Are you satisfied with what gold's doing? Because you could look at it and say, well, it hasn't moved much, and on the flip side, it's one of the best performing assets of the
Right.
year thus
Yeah,
far.
well, so I'm never satisfied because I want gold to be where it should be, which is at $80,000 an ounce. If you use the 1971 metrics and you look at M2 as opposed to the ounces we theoretically hold, gold should be at 81,000, which just shows you how much, they've demonetized gold and they've suppressed it and so on and so forth. But yes, your point is a good one. We were talking before we started here. I mean, people and I've got a lot of clients who are like, "Hey, Larry, inflation's raging. How come we're not making more money?" You know, and I'll get to that in a second. But the you know, year to date, gold is the best performing asset class. I don't think many people know that, right? I mean, it's only down, it's break even to down 1% year to date. You know, the Nasdaq's down 25%. The S&P was skirting with being down 20. I guess it's a little less than that now. The Dow's down a lot. I mean, you go through the general marketplace and it's down quite a bit. The interesting thing that goes with that, is in the past when the market was down like that, you would think, okay, well, at least bonds caught a bid and bonds were a good place to hide. Well, no. I mean, bonds are down too. TLT, the 20 year, the 10 year. And if you've held bonds, you've lost money too. So there's really been almost nowhere to hide this year, with the exception of oil and gold. And gold is, I mean, you can't eat a negative relative performance. Let's say we're down 1%, but the fact of the matter is, that's a whole lot better than being down 25% if you were in the high flying NASDAQ. So, and I think that separation is only going to grow and persist as time goes by. To the answer the question of why hasn't gold performed better, well, right now, we've had a very strong, Volcker-like response from the Fed, which has driven the dollar up quite a bit. And the general narrative that he's portrayed and that people have bought, because it's surprising to me because I mean all these Fed people are so full of shit and everything they say is wrong and they're lying all the time, and yet there's a big part of Wall Street that listens to them and believes it. And so they're buying the thesis that, I know what the Wall Street story is. It's, Putin's going to be overthrown by the oligarchs who are pissed off that they got their yachts taken, and the war is going to be over. And then, the COVID supply chain stuff is going to resolve itself. And we're going to go back to a deflationary 2% environment. And all these financial assets are going to come screaming back, and you don't need gold. And that's the narrative that's
Mhm.
causing a lot of people to not come into gold. And if you believe that narrative, great, then don't buy any gold. If you're like me and you look at the math and you say, hang on a second, there's no way they can get out of this box they're in without printing a lot more money, and it's very unlikely that we're going to have an immediate supply response in all these commodities that we've underinvested in for 15 years. Then you say, I'm willing to bet that inflation surprises to the upside and continues. And, yes, Powell is talking tough about inflation right now, but he's got nothing. He's all hat, no cattle. And so, it's gonna catch up with him, and people are gonna realize, you know what? I mean, here's what needs to happen, Daniela, for gold to go to the moon and for Bitcoin to go to the moon, and they both are gonna go to the moon. Here's what needs to happen. People need to realize a big, broad swath of investors and people who make the decisions about where to put their money need to come to the conclusion that they can never stop printing, ever. They can't. It's what Max Kaiser said. You can't taper a Ponzi. We've got a financial Ponzi driven by free money, 0% interest rates. Bernanke was the super
Right.
spreader with his 2002 speech. And, you can't taper it. I mean,
Why,
they've
why
even,
can't it go back to pre-Bernanke days,
yeah.
Lawrence? Why not?
Why can't they? Well, they
Yeah.
could. Yeah, yes, they could if they're willing to see half the country go bankrupt or more. If they're willing to have something that looks like the Great Depression,
Okay.
they could
That's the
do it.
only way.
That's the only way. All of the malinvestment they could make the dollar sound again, but all of the malinvestment would have to be cleansed, and the federal government would have to balance its budget. And think about that in the context of tax revenues would go down because everyone, you know, in the Great Depression, 35% of the country was unemployed. So they
Yeah.
weren't paying any taxes. So
Right.
take our, let's say we have an analog to that. Take our taxes down by 35%, and then, oh, and then by the way, we've got all these automatic things that kick in when you have a downturn,
Yeah.
welfare,
Yeah.
food stamps, etc.
Right.
We're going
But
to
no
blow
one
out the
wants to go through
deficit.
that much pain. So it's like, okay, let's just keep printing. Let's just keep printing.
That's
Let's just
exactly
keep printing.
right. People, I mean, at the end of the day, the decisions are political decisions, right? So this doesn't have to be inflation forever culminating in Weimar, which is kind of what I see unfolding. It could be, sound money, return to a dollars, return to a gold standard, reset and restructure. I mean, if you look at history, that's what Roosevelt did in 33 and 4. I mean, he grabbed the gold, which was illegal, but he did it. And then he devalued, the dollar 70% against the gold. And that obviously that wasn't enough because it took a while to get out of the depression. But the point is that that's one possibility. I mean, you have two choices here. You can either say we're going to clean up all these excess and make the money sound again, but the cost of doing that is going to be extremely painful. Or you can say, well, let's just kick the can again. I mean, my view is a guy like Powell, he's not thinking 5 years out. He just wants, I mean, I don't know why he took a second term. I mean, to me, that proves that he's stupid that he took the second term.
Well,
Seriously, who would
everyone says
want to
it's
be in
a
his
job.
shoes,
Right.
given this constellation of facts, right?
Uh, just a final thought before I let you bring it home here, um, because you are one of the few who sees Bitcoin and gold as
Yeah,
part of the same
yeah,
team. You're bullish on both.
yep.
Thoughts on what's going on with the cryptos right now? Is for you first and foremost, in the space, is it Bitcoin or nothing? And
Yeah,
two,
for me it's Bitcoin or nothing. I mean, there's so
okay,
many of us who are I'm a maxi, I'm a Bitcoin maximalist, and this is really important. And it's really, these shit coins just piss me off no end. I'm sorry, I don't probably not allowed to say that on the show, but the what happened with Luna? I mean, I had a couple of gold guys call me the other day and say, look at what happened with Luna. I'm glad I didn't get into Bitcoin. And I'm like,
right,
no, I mean
right,
these are not the same thing. I mean,
right.
one of these is a gorilla and one's a sick cat, and
It was-
Bitcoin's a gorilla and
uh-huh.
Luna was a sick cat, I mean it's just they're not the same thing. And so unfortunately there are a lot of cryptos. But look, Bitcoin, the reason I love Bitcoin so much is I was a venture capitalist in my prior life and I invested in the internet, in 93 and it worked out really well. And I could see the technological innovation the internet represented and what it would do for the world. When I looked at Bitcoin, I read the white paper, I understood the technology. I didn't think of it in financial terms. I looked at it in terms of technology terms.
Yes.
They solved a technical problem that people had been trying for 30 years to solve, which was to create immutable digital scarcity. And when they solved that, it was a big deal, a really, really big deal. And it's the only one that truly has that. There are 18,000 cryptos, and none of those have what Bitcoin has in terms of the truly immutable digital scarcity, although a few are kind of close, but combined with the size of the network and the 100 million plus users.
So let's just take it one step further here and talk, the pain that Bitcoin has gone through now. How much does that concern you? Does it? Is this a crypto winter for Bitcoin? Is it
No, no,
temporary?
no, no. This is another great buying opportunity. So, I mean, just to take you through my journey, I bought some in 2013 for $300. I was buying at Thanksgiving in 2017, and everyone remembers that. Everyone's talking about it at 15, 16,000. Okay. I doubled down, at 3,500, I doubled down at 10,000 a year later, and then doubled down again at 3,500 a year after that. I mean, look, it's early days and it's adoption. And way back then, by the way, we didn't know if the technology was going to make it, but we've now got a lot of years that and a lot of innovations that are leading me to conclude with pretty high certainty that it's going to make it technically. And so what you're being given here is just a gift. I mean, it's trading below its 200-day moving average. There's a multiple called the Meyer multiple, which I use very much in pricing Bitcoin, which is comparing the price of Bitcoin to its 200-day moving average. Right now, the price of Bitcoin today has only been this cheap compared to its 200-day moving average 6% of the time of its life, which means that 94% of the time Bitcoin's more expensive relative to its 200-day moving average than it is right now. I'm buying Bitcoin. I bought some Bitcoin this morning. I'm moving some money around. I'll probably buy some Bitcoin later this week. So to me, this is a buying opportunity. The selling opportunities in Bitcoin come when, everyone with laser eyes is putting down every $1,000 that it goes through, and they're all crazy nuts talking about how it's going to infinity, which, look, it is definitely going up over time, and I suspect we'll see it in the hundreds of thousands within a few years, and I do believe in $1 million a coin, but it takes time, and it's an asset class that's extremely volatile, and that's why, when I advise my clients on it, I say, look, you know, deal with something you can afford to lose, deal with something that you can afford to have an 80% drawdown on, and then dollar cost average it. Just get involved and just buy it on a regular basis, because it's not a 1 year holding or a 2 year holding. I view it as a multi-year, multi-decade holding. I mean, I think I'll end up giving my Bitcoin to my kids, and I think it'll end up being, a pretty substantial, amount of purchasing power. So,
I appreciate the transparency there, Lawrence. I guess just final thoughts to conclude this incredible conversation. Thank you, by the way. Just, words for the folks out there listening, Lawrence.
well, look, it's really tough times, and I get that for everybody. It doesn't matter where you are on the spectrum. I mean, you know, I make several points. I think that everybody, to protect themselves, needs to be in sound money investments. Some portion of their assets need to be in sound money investments. If you're heavily invested in bonds and stocks, I sincerely suggest you that you get out of some of those to some point, to some extent, and you buy sound money assets. Okay, that would be gold, silver, Bitcoin. Okay, and gold and silver mining stocks. The second piece of information I always try to give, because I've seen people say, lever up and buy Bitcoin, is no. This thing is going to, Bitcoin's volatile, gold's going to be volatile, and we are going through an incredible economic shit show.
Yeah.
and, and leverage is really, really, really dangerous. I
What
mean,
would
I've
cause
seen
the
people get
volatility?
blown up.
Sorry
Yeah,
to interrupt, Lawrence. I
no,
don't want to interrupt you.
that's all
But
right.
what would cause the volatility in gold, which we've never really seen? Why would it appear?
Well, I think we could one day see a gold reset. I mean, China and Russia are betting on gold, and they've got a lot of it. Gold is deeply suppressed, and deeply suppressed by a paper, scheme that, has created hundreds of ounces of gold for every ounce really in existence. I think there's some chance we'll wake up on some given Monday morning and gold will be at $5,000 an ounce, on its way to a much higher number. And people will be saying, okay, yeah, give me my gold. And, things like GLD will be saying, well, sorry, we don't have it, because some of the people who contracted to give it to us are now Lehman Brothers, because and everyone who's short gold, won't be able, they'll lose so much money that they'll be bankrupt, and they won't be able to deliver on their short. So gold could become quite volatile as well. I don't necessarily think to the downside. I think more volatile to the upside, because it's just so silly cheap right now. And silver is too. It's the same story with silver. In fact, silver is even more so the case, because at least with gold, you've got a big stockpile, of 20,000, 200,000 tons that have been mined. Most of what's been mined is still around, unless it's at the bottom of the ocean. Silver is hand to mouth, right? It comes out of the ground and gets used, which is why it's more volatile.
Well, I appreciate your thoughts, Lawrence, and
Well, thank you.
thank you for helping us try to
Well,
navigate these very troubled waters.
it, it,
But
it
we'll
it's
keep
gonna
smiling.
it's gonna be difficult. Here's the other thing I would say, just to end on a very
Yeah,
positive note.
please.
We will get through this. This will be difficult. We will get through it. And on the other side, I think most of the world will understand that we need a sound money system, and we will have a sound money system. And our kids and grandkids will say, I can't believe that they let 12 people in the Federal Reserve set the price of money, and that caused the
Maybe.
second great financial crisis of their lifetimes. And honestly, on the other side of it, when we do return to sound money, given all the technology we have and all the great things going on in this world, it's going to be so much better. I mean, it's going to be awesome,
Yep.
absolutely awesome.
Yeah, yeah,
It just
yeah,
it
yeah.
just sucks right now, because there are people who are hanging on to this old system, and they need to just let it go, and we need to reset to a new system that's based on sound money.
Yeah.
So
And
I'd
I
end
think
on
the new
that.
generation might just get it. I agree
I
with you
think
there.
that's right. They all
Yeah.
read Seyfedine's book. The millennials totally get it. They can't afford houses. Their boomer parents have accumulated all these assets. I mean, yes, millennials get it, and they are going to fix this system. And And when they do, the corruption will go away. So many things will get better. So I just want to say that I'm extremely optimistic for maybe 5 years out. But I would also suggest that in the next 5 years, we should all, batten the hatches because it's not going to be fun.
Lawrence Lepard, come back anytime. I love speaking
Anytime,
to
Danielle.
you.
Happy to do it. Yeah.
Really, really good talks. I love that. Thank you so much, Lawrence, and
Thank you.
thank you all for watching. We'll have much more incredible content coming your way on Stansberry Research, and don't forget to sign up at danielacambone.com to stay on top of all these awesome interviews. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.